Okay. Hello, everybody. How are you? Who wants to save the world? Yes, that's the right attitude. Here at the sustainability stage, we want to save the world. We want to save the world with tech. And it's my delight to be with you today, all the way from London. And so say hi if you're in London. I'll be saying hi to all the Europeans later. London's still in Europe, by the way, despite Brexit. Now, we're going to have a fantastic day today. Sustainability is more than just a buzzword. You know, it's a real moral imperative. And there's so many new startups in the space, as well as, obviously, the tech giants addressing these issues. We're going to shine a spotlight on these issues, and you'll hear some fantastic panels and speakers. We're going to covering solutions, challenges, opportunities. So let's keep the energy high. Let's keep the ideas flowing. Now, don't worry about taking notes, because floating around, there are screens with the Otter transcription on it, and you can go to otter.ai and see the transcription there, or just use the QR code floating around that you'll see. But without further ado, ladies and gentlemen, I'm going to kick things off by introducing our first panel, Raising in a New Climate. I hope you like what we did with that. To kick things off, every VC has a climate VC fund these days. So let's chat to the investors about the current headwinds facing climate tech. We'll have Bronson, who's Managing Director of SOSV's IndieBio and General Partner, Arvind Gupta, who's Partner at Mayfield, and Libby Wayman, who's Partner at Breakthrough Energy Ventures. And to guide this discussion will be Kirsten, Korosec, who's TechCrunch's transportation editor. So please, ladies and gentlemen, give them a big, warm welcome to the stage. Come on up.
All right, well, thank you so much for joining us. Thank you, audience, for coming. I'm excited to see you all. I've been really looking forward to this because sustainability is sort of the area that I'm most interested in, usually through the lens of transportation, but certainly sustainability touches so many sectors. So we have you all here today. And I thought, let's start with the bad news, and go up from there maybe. Dollars flowing into climate tech startups dropped 40% in the first half of 2023, according to, I believe it was Climate Tech VC. So, Libby, what is driving this? I know interest rates is a fun one to put out there, but what else is driving this besides interest rates?
Yeah, I would say that that rather than kind of driving a steep drive off a cliff, the question is really what happened in the last few years that made climate so exciting, and where are we now relative to kind of a longer term average? I think what we all know is that hard tech is hard. Climate is often kind of finds its way to manifest in hard tech, and it's a hard thing to support with entrepreneurship for a number of reasons that we can get into. And so it's always been kind of challenging to start a business, to capitalize a business, and to see it all the way through to commercialization. In the last few years, we had an amazing window for climate where interest rates were low, but that was true for a long time before that as well. And then the public markets were also pretty elevated, and so investors who were really exposed in the public market side also wanted to come into the private market side. And then the third major trend is that the world has begun to wake up again to the eventuality of climate change, the impacts that are happening today, and to the need to support innovation in climate. And a couple things have changed in the last year. Probably interest rates are a big one. Also, the correction in the public markets kind of and the exposure that later stage investors have had in public versus private. And so we've seen a little bit of a pullback in the investment landscape for climate, but it's still actually quite elevated from where it was, call it 5 years ago. So it's not all bad. Everything is relative. So we're off of the kind of all-time highs, but it's still trending up and to the right in terms of the longer-term trend.
Arvind, I'm wondering if you're seeing, in terms of resistance, the resistance that is there, even though there is a little bit of recovery, are you seeing in certain specific levels? So just at early stage, or more in that transition from early stage starting to become into growth? Where are you seeing resistance, and where are you seeing some of the like rosier sides of investing right now?
Yeah, so I think the earlier the stage, the more capital is freer to flow. So the seed, the pre-seed stages are continuing unabated, in essence. And I think as you get up to Series A, there's a lot more discernment around what to invest in. And then Series B and C, I think it becomes a lot more on metrics that are harder to achieve these days. And so that's where I think, what Libby was talking about, where what are those metrics? Those things have changed. That's the new climate that we're talking about here. But I think the entire capital stack is adjusting, and the problem of climate is not going away. And I think every summer is hotter than the last. We see it in the data, we see it in the news, and I think capital is looking for these solutions. So I'm actually very positive and very optimistic that there will be capital the entire way forward.
Oh no, he's got a mic. Okay.
Can I chime on this a little more precisely, Mike? I'm going to chime on this a little more precisely. We did an extensive analysis 3 years ago, which was showing that a lot of the climate money was being spent at mid to later stage, and there was a paucity at the early stage. Now all these seed climate funds have raised. What's happened is some of the later stage players have taken a bath. They're underwater in late stage portfolios. And when they're writing $100 million checks, it doesn't take too many of those $100 million checks to not get spent for all of a sudden the whole thing to get distorted. And so I would say that the numbers, I don't have confidence in their accuracy per se, because there was a lot of note round financings that aren't going into pitch book. Companies are being supported or bridged. I think that there's just also like sort of a data integrity problem here, where people are trying to figure out what to do with some companies that often, most fundamentally as a problem, had a very high capex, a need to raise big checks that weren't there. Maybe perhaps they were expecting project financing to come in at their stage. It didn't come in, and that's changed strategies where we look specifically now at super early stage. We do pre-seed and then on after that at super low capex systems, so we don't run into that problem in the future.
Well, isn't it also a problem that climate tech is so broad? I mean, there are certain aspects within or sectors within climate tech that are doing really well. I mean, a few weeks ago, Redwood Materials, I don't know if I can call it a startup anymore, they raised $1 billion in a Series D. So we're seeing money go into certain areas. I guess I'm wondering if there are certain sectors, Poe, you can weigh in, but I want to hear from both of you, where you're seeing the most trouble right now.
Most trouble. You like talking about trouble.
Trouble.
Okay, you're throwing it to Arvind.
Okay.
In terms of
food
funding.
tech, I'll just say, I have a large food tech portfolio. Arvind started it when he was built IndieBio, and we've continued it, and that is pretty flat in the markets these days, and struggling again with capex issues, amongst other issues. Luckily, we feel like there are other solutions behind that, and it's too big of a massive market, and people, luckily, eat 5 to 6 times a day, so they're always needing new products. So it's still very investable at the very early stage. And so I'll own up to that, which is that the late stage of that portfolio is tough right now. I'm going to let them talk about some other sectors.
Yeah, Libby?
Yeah, I don't think it's necessarily sector by sector, although there are some kind of public comps that color late stage spaces, kind of like food tech is probably a good example of that space. But I think it's kind of back to fundamentals. Are the companies in growing markets, do they have a large capture of value in those markets? Do they have a great team that can execute? So it's really back to basics. We have seen, Redwood is a great example, companies that are very capital intensive still able to bring in the funding that they need to grow. And so I think it's also about being kind of straightforward about what you need to execute your plan. And if you need $1 billion to take the next step, be upfront about that, find the investors who are aligned with that, and what they need to see to make an investment. And then if you can execute on a more capital-light business model, consider that. But really find the investors that are aligned with your business model and kind of focus on the basics.
Yeah, for me, the question is less about what's in trouble versus what is working, right? So what works? Really great teams that can execute in a fast-growing market, as Libby said. Like, that's Redwood Materials in a statement. So I think across all sectors, those companies are rising up and accreting all the capital. And so it is going to become, or is becoming, that kind of a market at the later stages. So the pre-seed and seed are innovating the ideas, and you're getting a chance to build teams, create market fit, actually get to some sort of commercial traction. But really then the later stages are choosing, okay, well, these are the companies that really we want to put a lot of wood behind.
You mentioned teams, and I'm sure there are some founders in this audience. So what do you mean by that? And I would like to hear from all of you, but Arvind, since you brought it up, what exactly are you looking for as an investor when you say teams? And everyone get your pen and pads, start recording, because I'm sure you're going to try to pitch them later.
Yeah.
What are you looking for?
N of one teams. The best team on the planet for a specific problem they're trying to solve. And so that comes from not just the CEO, not just the CSO, but the entire organization. And a mentality that you're building a company that makes a product and a range of products that eventually solves a sector. Not, here's the technology and here's the solution and that is going to solve the problem. It's never that simple. You need it takes a village. It takes a company to solve these problems. And so that's really what we're looking for. And those are the ones, the teams with that mentality are always thinking, where are the holes? How do we get better? And hiring above themselves, and they rise.
Oh.
Well, we're always looking for scientists who've made an invention, a breakthrough, and we're building off of that. And we're looking for ones that have sort of a pure talent for very fast learning cycles. Ideally, a founder would have founder market fit. You know, if they're doing fuels or e-fuels, they would at least come out of oil and gas or something like that. Maybe not in fuels particularly, but you often don't get that when you're getting a brilliant scientist coming out of a university. And so you're looking for just this great knack of learning and a dead seriousness about what, and with no inflated expectations about what they're worth or how good they already are. They're really willing to learn to adapt to the culture of a new business. Every business sector has its own seasonal cycles, its own business tactics and habits, and you've got to learn all that in order to one day disrupt it.
So brains flexibility over business model.
Business model, a great question about business model, but that wasn't exactly what you asked. We can maybe go to that next because I want to make sure Libby gets to talk about teams.
Yeah, I think these two are spot on, and maybe to just build on, I think especially what Arvind said is when you are a founder that has an amazing scientific breakthrough, maybe you're a postdoc, maybe you're a PhD student, you're going to say, well, I haven't been in the oil and gas industry for 20 years. That's fine. Are you able to pull those people around you? Are you able to not only hire above yourselves, but at an early stage, can you bring in an advisor? Are you able to kind of respect that those kinds of experiences and perspectives are really valuable? And then are you able to communicate to those experts the value of your innovation and where you're going with it, and in a compelling enough way that they're compelled to spend their time with you?
A quick follow-up, because when you were talking about teams, all of them, and I do want to get to business model as well, but how important is it for the teams to be heavily weighted more on the technical expertise than the business side? And that will be a beautiful segue for Poe to pick up after this. But Libby, quickly, and Arvind, technical expertise, you are looking for overweight on that for your teams?
I mean, it has to be there. It's so dependent on and kind of bespoke to each company. But we have definitely invested in founders and CEOs who are technologists as their core background, and they're able to pull amazing people around them to partner with them on the business side. So, some funds say, we don't want to invest in a technologist as the CEO. We've had great success with doing that as long as they have, a strong partnership and all the other aspects of the company. We've also invested in teams where there's the founding technologist is the CTO. So it totally depends, but you just need the right complementarity in the team. And I think, as Poe mentioned, just the awareness, the wherewithal that you need different perspectives and areas of expertise.
Arvind, did you have anything more on the
Sure.
technical?
I mean, just to add on briefly, yeah, I think the technical expertise has to be there. That's table stakes, right? Without that, you're probably not talking about a deep tech company, right? And you're talking about an execution company with no moat. So now the question is, where is the technical expertise? And as Libby said, I think it doesn't matter if it's a CTO or CEO, as long as the CEO's job knows that their job is to raise money, hire the best people on the planet, and tell a great story about the mission and get people excited and involved, and not to build the product, because that's where people get in trouble.
Yeah.
Technical CEOs that want to really be the chief product officer or the chief technologist and doesn't do the job of the CEO, that's where the issue comes. So it doesn't matter where it exists in the organization as long as everyone's clear as to what they're doing.
All right, so now we're back to the business model part.
Well, I'm just going to hand it to them again.
Okay.
But, no, I mean, we say don't scale your problems. If you don't know exactly what your business model is, that's a problem. Don't scale it. Don't get too big till you figure this out. Figure this stuff out early. What is your product? What are your margins? What are your economics? But more importantly, what is your sales cycle? Who really wants this versus who might want it? And pressure test on that. We're expecting all of that to be done really very, very well, easily done on a pre-seed check, at least, if not, significant traction, true traction coming off of that. And I'm not saying on premise alone. It's not just at an idea stage. You're also executing on the technical side. But you can speak more to you guys to margins you're looking for and structures that you're looking for. But you can't push that out, and you can't try to take in money and grow your company without that getting solved.
Libby, do you want to speak to the margins part, or I don't know if you wanted to respond to a post that said specifically, but the business case is also interesting to me.
Yeah, I think business model is absolutely essential to think about that going in. That that dictates so much what your financials will look like, what kind of capital you need to raise, the kind of investors you need to have with you on that journey. And I think maybe you can operate for some amount of time, like as a decision tree, kind of being in the trunk of a tree, needing to de-risk a few things before you actually execute on the business model. But you'll need to really very quickly not only be able to articulate your business model, but have some some backup as to why you think you can execute on that. So it's kind of the equivalent of early sales or LOIs or things like that. If you're planning to partner or JV or license, that's just another form of sales that you'll need to execute on. And kind of what gives confidence in your audience and for yourself that you can execute on that kind of business model. In terms of margins, there's a lot of different ways to build a valuable company. In climate, the entire economy, if we really want to get serious about climate, will need to be rebuilt. And so there's enormous value to create in a number of different business models and different margin profiles. But again, you just have to kind of take all that math into account in the beginning. And certain sectors get really hypey at certain points. Don't price yourself out of the market at an interim stage if you're a lower margin business model and you're going to have to raise more money down the road. So just try to be clear-eyed about it and keep your eyes on the end goal and how you're going to get there.
Arvind, and you can all weigh in on this, but I'm wondering, in terms of the climate tech perspective, when you are investing, sometimes these are really more frontier tech, like it's going to take a while. So when you're looking at it, is your return on investment expectations longer? I mean, are you more open to add a few years before you get that payoff, or not?
Well, unfortunately, you can't, because funds are structured to be 10 years with 3 one-year extensions. That's a max. Right? There's no, it's not up for debate. So what you're talking about is a structural issue in financing around venture versus other models, where the time horizon for an exit could potentially be longer, but they may not exist. So no, it's 10 years, and you have to look at it within that lens and make sure that you're making decisions that fit that constraint.
Is that the same for both of you?
I want to speak to the audience for a second.
Please.
Okay. This is a great time. I don't want to be negative. This is a great time to be doing a climate tech startup, despite everything that we're saying here. And we are seeing advances that look like magic compared to stuff that was possible just 3 years ago. What we see startups kind of underestimating is underestimate how many other startups are doing almost exactly what you're doing. And they also underestimate how smart the good VCs are about that entire landscape and knowing all the technical details. So it's a lot of like sharpening that has to happen and clear, slight differentiating in crowded markets, because climate tech is hot and it is crowded. And there's 100 hydrogen companies and 100 carbon X companies. And so that differentiation to make it stand out and explain clearly why that will win over others is like really, really critical super early on.
Well, let me, one going back, right? So the time frame is a bound for funds to have to exit. And generally, if the company is still going, you have to sell the shares on the secondary market, which tends to trade at a deep discount. However, if your company is doing very, very well and there's a lot of demand for those shares, it doesn't have to. And so if you look at SpaceX, there's an example of a company that's far past 10 years that's very valuable, and their investors did very well in the venture side. So I think the key is look for business models and approaches that you can increase the rate of your cash flows, increase your sales cycle. These are things that you can functionally and structurally do with your business. And like Poe said, with really good VCs and really good operators and people that understand the business, the industry, figure out how to do things that might be a little bit different than the standard. When you have a technical innovation that really changes the game, oftentimes it's the business model innovation that is able to capture all the value that the technical side created. So there's really 2 halves here: create value, capture value. And a lot of people forget about the capture value side.
Right. I'm glad that you brought up the differentiation, what's kind of climate 2.0, I guess we're calling it, in terms of the sharpening. And the big distinction to me is, aside from, I guess we haven't seen a bust yet, as we did back in around circa 2008, was that back then it seemed like startups were going after the incumbent. And now it seems, as you mentioned, and you've all kind of referred to, is competition within each other. And that to me seems both really exciting and interesting, because you have all these startups, but also a lot of pressure, a lot more competition. Libby, I'll kick it to you first. How should startups think about standing out? I mean, Poe, you kind of referred to it, but I'd like your perspective as well, because things have changed. They're sharpened. They're so competitive now.
Yeah, being aware of the field in which you operate is really essential. So being aware of what your competitors are doing, not only from an incumbent side, but within startups as well, is really important, because if an investor is talking to you, you have to understand that they're talking to every single company in your space. So if you don't have the awareness of what your competitors are doing and why you're so confident in your approach, it will be a big struggle for you to help your potential investors understand that. So just gain that awareness and keep sharpening, and it'll also increase your own conviction about your own approach.
Oh?
Well, the stuff we're funding today pretty much is trying to disrupt Libby's companies. And she's really good. She has an amazing portfolio. Lots of companies have hundreds of millions of dollars of revenue. It's fantastic. So like, that's hard. You know, like we're not actually competing with oil and gas or battery. We're competing with her stuff, like and people like hers, right? And the VCs know that, and that's even harder.
So what? How many checks have you written this year? About ish.
18.
18. Arvind?
This year, none.
New companies. Yeah, 18 new companies.
Well, one.
Lots of follow-ons.
Yeah, one.
Libby?
Yeah, it's a good question. I don't have that number off the top of my head. Fewer companies new companies than last year. We've been spending a lot of time with our portfolio and kind of supporting our portfolio. We have made new investments. I don't have the number off the top of my head.
But usually more of like follow-on as opposed to new companies?
Oh, I was talking strictly about new companies.
New companies, okay.
Yeah. I have way more than that in terms of follow-ons.
Okay. So 18 is, you've had the number off the top of your head. So
Yeah,
what were you investing
I know them
in?
all.
What are you investing in?
E-fuels, materials that can really scale for apparel, specifically melt spun technology, drop in for melt spun. All materials innovation in apparel has really been on wet spun and other types of more expensive machinery. We've done green ammonia or emissions-free ammonia. We've done bio-leathers. We're doing rare earth extraction out of hybrid motors rather than, say, out of the ground. We're doing biological approaches to lithium extraction from diluted brines or oil-filled brines, which is called processed water. You know, like the gamut, basically.
Yeah, it sounds like
the
a gamut.
gamut. Like at Hacks, we did like battery companies, like metal light. You know, other forms of energy, like the gamut, the whole thing.
Okay. Well, I'd like to see if there's a comparison. Are you both doing the gamut or are you specializing in specific new investments in
The
specific areas?
gamut, that's probably the wrong word. Let's find a whole spectrum, maybe.
Yeah, we kind of divide the scope into 5 categories: electricity, transportation, manufacturing, buildings, and food and ag. And we have worked really hard to find what we think are the best teams and best companies really across the major themes in all of those sectors. And as we look, and then the other thing that I think we've always challenged ourselves with is why now, not only for a company, but for a theme. Like, why is materials extraction from motors important now? Why, we made a lot of investments in the electric vehicle battery supply chain a few years ago. Why was that important now? So I think you'll see us thinking about that a lot more also going forward, and the areas that we invest in may change. We've opened our scope to adaptation, for example. Still absolutely need mitigation. Without mitigation, we're going to have a much more difficult climb on adaptation. But we're going to be investing in some new themes, not necessarily having to check every box across the spectrum, but some new ideas and why those ideas are important to consider now as we think about climate change.
Yeah, so we invest in problems, like big, giant problems that are real and cause great pain across industries. And broadly, you can divide it. We have 3 categories. It depends on how you slice things, right? One is just all the carbon emitted around feeding the world. Second is all the carbon emitted around building the world. And then the third is all the carbon emitted around powering the world. That roughly covers all the carbon flows through the planet as it pertains to humanity. And so within those are a bunch of different sectors. And then there's problems within each that are what we call keystone problems. And there are various technologies that can be used to solve those keystone problems. And one of the things that we really look for is we're people first. We're the great founders that have an insight into solving very specific tractable problem that's a bottleneck that, if solved, causes a whole range of other things to become restructured. That's a history-making type of company.
Okay, so I have two quick follow-ups for you.
Yeah.
So one or two areas that you feel are oversaturated right now, what would you say? Poe mentioned like lab-grown meats, but what are one or two areas that you're seeing that feel oversaturated?
Gosh, I don't really know what's oversaturated, to be honest. I'm not punting this, but I'll tell you what I'd love to see.
Okay, well, that was going to be my next question, but I want to put out a scenario for you, which is you talked about looking for the next great founder, and I'm wondering if, an area where you're seeing just a lot coming your way, but then you see that great founder, are you still going to invest in them even though you feel like there's just probably too much competition?
So, yeah, the question is really a matter of stage. So if an area is saturated and you see a really great founder, but they're raising a lot of money and the feature set of that sector is not really understood by the customers. So in other words, let's say there's like 100 different startups, all with a different version of a product trying to solve the problem. And the customer hasn't said, hey, this is the feature set we like and want. You could have a great founder and you could assume they're going to find their way faster and out-execute to that feature set. But it gets hard to write a very, very large check against that if it's not well understood. So that tends to just move the check into a smaller, like more seed style. If the feature set's understood, or if it's a heavy infrastructure type of investment where there's necessarily fewer players, then you could write larger checks and things like that. So it's not so much as, oh, we won't look at something because it's quote unquote oversaturated. I'll never think that way.
Okay.
Until a problem is solved, it's not solved.
But we do have a bar for when we reinvest in that same thing, because we call it playing from behind, and a lot of what people in this panel has done has been first to market with something, back in the day. And if you're doing a playing from behind, you're coming into this market now, we sit down with the founder and we're like, you have to understand you're playing from behind. You may be hot right now, but like we go through the metrics and say, this is what they had to raise, this is when they got to revenue. You have to be 3 times less or 3 times faster or 3 times more in every single dimension in order to win if you're playing from behind. And we look exactly for that. So not 10x, but 3x on lots of dimensions.
All right, one word each. What sector do you want to see more from? Libby, I'll start with you.
That's a great question. I should have been prepared for this one. But right now we're kind of in a stage where, to be honest, we're just really open to new ideas. I think we feel really good about the portfolio that we've built, as I mentioned, kind of covering what we think is the landscape of things that are really important for climate, and then also identifying a few themes that were really important for us to invest in at the time. And now I think we're just in a really interesting, fun, generative stage of being really open to new ideas, just to be totally transparent and like brutally honest with you right now.
One word each.
One more each.
I'll do
Well,
an ag.
Ag, okay.
yeah, it's something that I echo Libby. One of the hardest parts is just seeing like literally brand new ideas to mitigate climate change, where it's a completely fresh and orthogonal way of thinking. It just that to me is, I think, the hardest thing.
Okay.
But some things, new sectors that are emerging that I haven't seen before, really since this year, is a lot of Gen AI or software systems for software for industry operating systems is the way I'm terming it. So like, how do you make industries or entire sectors more efficient through the use of software and sensors and things like that? And there's a lot more of that happening these days. So
That was way more than one word.
way more.
We have to go. Thank you so much, audience. Thank you, all of you, for joining us on our stage.
Thanks, guys.